Hey everybody, my name is Kyle Knott, and I am not your average finance guy. I was talking with a potential client here the other day that has some safe money that they want to continue, and they're worried about the safety. So what they were looking at doing is a CD. They wanted to put money into a CD, and they said rates are really good right now. So I kind of did some digging, and I not to dig into their story a bunch, but I what I did was I went on Bankrate.com and I found what is the biggest the highest CD rate that you could find right now. And as you can see behind me there, 4.25% CD was the best I could find right now. That's a 12-month CD. So that means that every year this couple was going to consider what they're going to do first. They were going to throw $30,000 in the first year, and they figured that they'd be able to throw $20,000 a year in after that up to 10 years. So as you can see from the inputs there, they'll throw in 30 the first year, 20 every other year until they get to 210,000. I asked my kids to be quiet 10 minutes while I make a video. Can it happen? No. Okay, anyway, back to where was I here? Inputs are $210,000. So that's all we're going to put in over a 10-year period. $210,000 are going into this system. So what they were thinking about doing is they wanted to go super risk free. They did not want to do anything to risk their money, and they wanted it to be safe while also making a decent rate of return. And 4.25, I guess, to them is a decent rate of return from where CDs have been. Savings rates have been terrible lately, so at 4.25, that's what we ran with. And what we did, we just kind of locked everything. Here's where it is right now. Let's lock it and go to see project forward what's going to happen. I mean, obviously, if some goes up, things will go up, down, but you can't plan for any of that. So let's just plan for what we've got here. If things go up, they go up. If they go down, they go down. So as you can see here behind me, we've got from year 1 through 5. Those are the numbers. Then I just went 5-year increments down to year 35. So if they keep this in here for 35 years, $522,000. Okay, almost $523,000 after only putting in 210, and you've got 552. That's not a bad return, right? That's a lot more than you put in. It's 35 years down the road. So if you know me and follow me at all, you know I'm into the infinite banking concept. So to me, what is safer than a certificate of deposit? Even though yes, it's FDIC insured, that makes everyone feel warm and fuzzy. The FDIC insurance only goes up to $250,000. So we're here 10 years into it, you're going to either have to split banks, split this up somehow, and who knows what that's going to do. So there's some more work to do. And honestly, I don't even think if something did go south with the banks, the FDIC, there's not nearly enough money in the FDIC to actually provide insurance for this stuff. But that's neither here nor there. So if we went into and put the same amount of money, all of this, into an infinite banking concept, and now the infinite banking concept has a guaranteed floor of 4%. Here you're making 4.25. That has a guaranteed floor of 4%, but if they pay dividends on top of that, it goes up, and they always pay dividends. They paid dividends every year for like almost 200 years. So it's not if they probably will, but you can't guarantee it. The guaranteed rate is 4%, and you're probably going to get money on top of that as well. So running the numbers off of the current dividend rates of the policy, what this does is, as you can see here, the first 5 years, the CD wins. Okay, so how long are you going to keep this in? If this is just a short term, I need to plow some money away for 5 years because I'm going to go buy a house, or I'm going to go buy something after 5 years, and I never want to put any money away ever again, then infinite banking concept isn't for you. It's not for everybody. I love it for what I do in real estate investing and investing in assets. I think there's no better way, and I've not heard of it. So if you know of something, please let me know. But as you can see here, even year 10, okay, the IBC is still behind a little bit. Okay, we get up to 15 is when it finally takes over, and once it takes over, boy, it really goes. So I know careful with my stick. I know what everyone's doing. They go right to the bottom line anyway, just like I do. So the CD is 552. The infinite banking concept is 904. Okay, this is your cash value, and you can borrow that at any time for any reason, and you borrow against it is what it is. So it's just that's your cash value that's locked away, and to me it's way safer than the CD. So, and then what you ask yourself, what are these dumb little numbers here on the sides that I threw in at year 10, year 20, and then at the bottom at year 35. And all these numbers will keep going if you want to, you can project them out for as long as you want. But those numbers are the death benefit. So you got a CD at, let's say, 15 years, and you kick the bucket, your family is going to get $295,000. If you're in an infinite, of course, I picked the one that I didn't have the number on. Let's say you kick the bucket in 20 years. In 20 years, you kick the bucket, your family's going to get $345,000. If you went the IBC method, put the same amount of money into an infinite banking policy, your family's going to get just shy of $1 million. Okay? No one plans on dying, even though we probably all are going to die. At some point, I ran this out 35 years. You can run this out as long as you want. The longer you run it, the better the IBC performs than a CD, and your death benefit keeps going up. The way we put these together with paid up additions is we rev up that cash flow as fast as we can. Yes, there's an insurance product portion of it, and that is why the first couple years that the CD outperforms it. But once you get this plane off the ground and it takes flight, now you're flying. So that's just one way to look at safe money. One little example. Some other things to think about too is with an IBC policy, you can either count it towards your assets or not. You kind of have a choice here because it's a little gray area. So we're someplace that maybe you want to count it if you're looking for, I don't know, a line of credit or something. If you're trying to open a business and it's like, hey, I've got all this cash value here that that could be looked at in the banker's eyes as an asset. It's okay, so that maybe that's something you would want to put it out there that it is an asset. How about if you're filling out your what's your FAFSA for your college aid? If you have a kid that's going to college and you have a ton of cash value, you don't have to put that on there. Okay, that is an asset that from there you don't want them to know that you have the asset, so you can get more free financial aid from the government. However that works. I got a 15-year-old, so I got a couple more years until we cross that bridge, but I'll be in it here soon. So the main reason that the IBC starts taking off is the taxes. It's all tax deferred growth. That all of this is growing tax free. All of this every year that CD, whenever that CD comes due, whatever you started with, you have gains on there. And I think you're up to $5,000 some or $22,000 in gains per year towards the end. And I just left that as you're still in the 25% tax bracket. So I took out probably the lowest amount of taxes that you would want to take out. Most will probably be in a higher tax bracket, but those numbers I ran were best case scenario for a certificate of deposit. I just kind of want to show, in my mind, how much better this infinite banking policy really is. So the taxes, the infinite banking, you really don't. If you play your cards right, you will never pay taxes on any of it. Yes, the money you put in is all post-tax, but so is in this example, so is the CD. So that doesn't really matter. You can take out a loan against this anytime you want. Okay, say you're 35 years into it, you found your dream home, and you want to buy a $904,000 house. Go right ahead. Get on the computer, say, yes, I would like $904,000. And in a couple of days, they'll have it either wired to you or a check, or in 35 years, who knows how they're going to do it. It might be instantaneously into your computer. Who knows what will happen at that point. So they're like, well, I don't want to have to pay that back. Guess what? You just took $900,000 of your $1.3 million death benefit out early. Don't pay it back. Doesn't matter. It's just this comes out a little bit less. So if and when you die, your house will hopefully be worth more than $900,000, and your heirs will get the house and a little bit less cash. So that's how that plays out. Let's see, the loaner tax free for anything, no credit checks. You don't have to go to the bank. How many times do we go into the bank and we want to take out a mortgage? We want to get a car loan, a small business loan, and you have to sit there and the banker sits there, in the big desk and arms folded and almost like you got to kiss my ring type of deal. Like, no, any reason, you don't have to give them a reason. If you want any of this money, you just I get online and I push a couple buttons, and in a couple days I have a check in my bank. Back to taxes, the death benefit is not taxed. Okay, so as long as you're under, I don't know what this new estate tax is, but is it 12 million or something? So I mean, as long as you're under that, I mean, none of this is taxed. And let's see, annual dividends. So the dividends that I talked about, that remember this is guaranteed at 4%, but there's been dividends on top of that every year for close to 200 years. So those are not taxed either. Those go in as prepaid premium, is kind of how those are justified in the tax world or whatever it is. So those go in and you don't pay any tax on those. If you get sued, what do you think a creditor is going to do? They're going to like, oh, hey, you have $400,000 of CDs? Yes, we'll take that. Thank you. At the same time, remember, you don't have to list your assets. This is insurance. This isn't cash. So it's protected in many states. All states are different, but in most states, they protect the insurance very, very hard, and it's very hard to creditors to get to. Now, I guess if you do something bad enough, they can get to it, but there's a lot more, way more protection on the insurance side of it than there is over on sitting in your bank account. That, it's there for the banking for anyone to take. So those are a couple of my favorite reasons why I think infinite banking concept is the way to go. So if you have any more questions, please let me know. If you're just interested in this stuff at all, be happy to help. As you can tell, I'm very passionate about this stuff, and this is stuff they teach us in high school. That's why I am not your average finance guy. I'm going to bring this stuff to light and try to help us all out, and we will make some money together. And good luck, everybody.